What's up, guys? It's Rego, an analyst in Wealth Group, a teacher in Wealth Group, an overall trader in Wealth Group. Today, I'll be breaking down very basics of my Pivot 200 EMA strategy. It's extremely simple to follow and usually looks to target intraday setups. So on a day-to-day basis, always looking for the same sort of thing. There are a number of trades to take from this, but today I'll be covering the R3 level, pivotal level, and the S3 level. We usually always look for the Pivot 200 EMA setup, which is the one I'm going to be explaining just now. So to start, I follow a basic pivot point standard, and you can find that in pretty much any indicator search that you look for. Pivot point standard, I follow Fibonacci. I set it to auto, and I usually only stick to one pivot per day, so that way it doesn't confuse me or give me other bias that I shouldn't be considering. But nonetheless, these are my setups. And the rule for the Pivot 200 EMA setup is I usually also include a 200 Q EMA. You can use the 200 EMA, but I use the 200 Q EMA, which is a quadruple. And the reason for this is our two levels that we will be discussing the most here is going to be the pivot and where the 200 EMA sits. Now, to get a setup like this going, typically in any traditional fashion or any given day, the pivot usually reflects the mean/bias of the day. So on an intraday chart, pivotal level is going to be the one that you assume if trading above, price action should target the upside, and if trading below, price action should be targeting the downside. In this case, we'll be looking at the upside, and for a number of reasons, but reason number one and priority reason is due to the 200 EMA and where it currently rests. Now, we have two different ways of going about it. The first one being if a 200 EMA supports the pivotal level, so one is underneath the other, and what I mean by this is that the 200 EMA supports the pivot by trading underneath it. Technically, we look to target the upside, and the reason for that is the bulk of bids, will be found more towards the 200 EMA, and as long as that is trending or progressing to the upside with the 200 EMA above it as support, we take it as a target to the upside, right? So our bias is bullish on a potential setup, and we pretty much take it from there, right? If it's the opposite, or in the case of a 200 EMA trending downwards with it being above the pivotal level, then we assume that the targets are to the downside and we should expect bearish price action. Now, of course, like any strategy, there will be discrepancies. There will be days where, you are chopped up, or days where the direction is not so clear. But in this case, I feel like we have a good example to go off of. So this system is very focused and based on triggers and execution more than it is based on an entry. So again, how we typically look to target and exit these sort of trades is we look for some sort of deviation underneath the pivot and the 200 EMA. So something like this, which isn't exactly definitive just yet, but it's something we look for, a deviation or a failed breakdown is what I like to call it, before a reclaim of the level of interest is usually what we look for to execute a trade like this, mostly due to the fact that we need a level of invalidation before we can look to target, and the targets are always going to be the same. You're always looking for a three-way split amongst these three levels up here, and we'll get to that in just a second, but you're looking for 33% split, 33% split, and 33% split. So with that being said, every time you look at the chart or every time you apply this strategy or this setup, your exits are always going to be the same. So again, these are pretty much definitive and set in stone. What becomes a bit more tricky is the invalidation, right? And to locate an invalidation, you'd need to have that confirmed before anything else. So realistically, I'll let the chart play out so we can get an example how I typically go about this. So realistically, we let, time develop and we look for that low until we can see a close above the pivot. And again, not just wicks, a legitimate close above the pivot after making a low like this. That's typically how we look to identify our trade, right? So we're looking for a low to identify a stop loss, and we're looking for a close above to identify the trigger, which is 109.537 level, right? Which pivot, the 200 EMA is supporting underneath. So everything checks out up until now, but we're going to let this play out and I'll continue to elaborate on what I'm looking for. We got a rough estimate of a close, but nothing too definitive just yet. And my reason for this saying is down here we have a volume oscillator, right? This volume oscillator, it's an FSVZO, right? Fancy RSI, really. Nothing too different. I would say the only thing that it probably separates it from an RSI is its ability to locate hidden and regular divergences on its own. A bit on the fancier end, but with an RSI, placing your own divergences and hidden divergences will have the same effect. We use this when we're looking for momentum on the level. I'll let this continue to play out and I'll explain and break down exactly what it is I'm looking for. So right here, we've gotten a pretty strong deviation. I didn't consider these ones mostly due to where the volume oscillator was trading. So if I go back just a bit, at the moment of impact, that really gave me the trigger I was looking for, right? At this moment in time, your volume oscillator is more towards the negative side than it is towards the positive side. So what's really important about this is when you're looking to reclaim a level, we don't want it to be on the side of extended, right? We don't want to be too high to the positive because, going into a level we're trying to flip when sellers have control is really not an ideal scenario. So what we like to do when we're looking for a trade like this is we like to locate our invalidation, but at the same time, we like to know that our volume oscillator is exhausted, right? So sellers are out of momentum and buyers have all the incentive to reclaim a level and to potentially push onwards, right? So at this point, up until now, I never considered any of these possible triggers just because of where the volume oscillator was trading. Whereas this time around, the most recent flush is actually in territory where we consider a more reliable setup should the level be reclaimed. So naturally, once I have these two levels figured out, this is usually how my trade looks. I try to keep an invalidation right beneath the low that was made because technically, if a trade goes back there, then realistically, it's not worth our time. And like I said, we usually look to target R1, R2, R3 on any given day. We like to exit gradually, let the trade play out. And typically, this is how it looks. Again, my only reason for not including this wick over here is because the trade at this point in time is not yet executed. So I really feel no need to adjust the trade. It should not be coming back here. Of course, the execution does not follow once or into the level as it's being reclaimed. It's triggered on the retest candle right here, right? So price breaks out, attempts to push above a pivot 200 EMA, and then falls back onto the pivotal level where it is then held and then pushed away from. And that is typically how a pivot 200 EMA trade is made. It's a lot of patience. It's a lot of waiting. It's a lot of development. It's about finding a deviation underneath your level of interest and having that pushed away and then confirm above the level of interest. Now, there will be times where price doesn't come back to retest and moves without you. In that case, it's not really a trigger. It's not something you can take. And there are times where you do get this retest and price does continue to fall down below. It's like any other system, but what's important is that you're following a strict set of rules. And that strict set of rules is you look for the deviation underneath the pivot 200 EMA, ideally on a bottomed out volume oscillator. You can't be looking for this while the volume oscillator is still extended because that assumes there's still sell pressure that could be coming your way, right? So what you're really looking for is a deviation underneath followed by a reclaim. And what's most important is your volume oscillator suggests momentum for the bulls. Because again, when you're looking to flip a very, very pivotal level, in this case, our pivot 200 EMA, there needs to be buyer momentum. We can't have a full extended oscillator because that assumes sell pressure is very, very high in a level that we consider the mean slash bias of the day. But if it's exhausted and you manage to reclaim the level, that's what initiates a trade. In real time, I showed you how a trade typically works. All things considered, it's a 3-to-1. And in the event that the market does manage to go south on you, there are 3 take profit points. So you're exiting gradually. And it also allows you to readjust your stops. For example, if you were to get your first exit at 109.804 and you don't feel like having any more risk allocated, well, you closed 1/3 of your position. And should it return, you can eliminate the stop at that point and not really put up any risk. So that's a crash course on the Pivot 200 EMA strategy. It's a rather small one due to most of this being found on weekend volatility, but it is set up nonetheless. And when the signs are there, it's usually when it should be taken. That's setup number 1.